All right, and with that, let's kick off. I'm so happy that you're all here and joining us today on your Thursday afternoon or morning, depending on where you are in the world right now. Welcome to the third session of our 2022 Spencer Summer Webinar Series. Really appreciate you being here. My name is Rachel Lieblein-Gerbala. I'm the program manager at Spencer. For those of you who may be less familiar with the organization, we are a nonprofit dedicated to supporting students who wish to pursue careers in the risk management and insurance industry. And we do that through scholarships and through internship grants, as well as through grants to universities and other organizations for experiential learning opportunities and also risk management and insurance program and course development at universities. I have a couple of housekeeping notes before we get to the main event today. The first is that this meeting is being recorded, just so you know, so it will be available on our website after the fact if you want to revisit any information you hear here today or share the recording with a friend who wasn't able to make it. Please feel free. Again, if you're just joining, please feel free to introduce yourself in the chat. We'd love to get to know who's in the room with us today. And finally, and Tim will also reiterate, we very warmly welcome questions as we go through today's presentation. So please feel free to use the chat function or raise your hand or unmute yourself as we go through. This is a very warm and welcome space and an intimate group. So please feel free to raise your thoughts and ideas and questions as we go through. And with that is my pleasure to introduce our speaker today, Tim Bunt. This is Tim's third Spencer webinar since we started this series in 2020. So we really appreciate him coming back once again. Tim has 39 years of financial services, energy, and insurance industry experience. So we are definitely in very capable hands today. Tim serves as Vice President of Marketing and Distribution at Everest Insurance, where he is responsible for Everest's key account management program, which includes driving the One Everest strategy, as well as the formation of Everest's Risk Manager Advisory Council. He is also the practice leader for Everest's Real Estate and Hospitality Group, which will be the focus of today's conversation. Before joining Everest, Tim served as the Chief Risk Officer of CBRE Group, where he held global responsibility for enterprise risk management. He has experience in insurance and financial services, including real estate with Alexander and Alexander and Prudential Financial, and also has extensive energy experience at Tosco, Whitco, and Texaco. Tim has consistently demonstrated his commitment to giving back to the insurance industry, which I can personally attest to, including serving on Spencer's board of directors, as well as serving as a committee member for the annual Ronald McDonald House of New York Insurance Industry Charity Golf Outing, where he was honored for his 10 years of service in 2017. Tim received his Bachelor's of Science degree from New York Maritime College. And with that, Tim, I will hand the floor over to you. Thank you so much for joining us once again.
Rachel, thank you for the introduction. And again, we stress throughout this presentation, I hope people ask questions because I could drone on for the hour or I can answer questions people are interested in engaging. So I much prefer people engaging. I also want to welcome you all to this call because a lot has changed since I started doing these webinars. My own firm, we're back to a 3-2 into the office. I'd say it's more like a 2. And people, managers are really left to the discretion. And it just shows the resiliency of our organization. We didn't miss a heartbeat throughout the entire COVID. And we're going to talk about risk management and real estate in particular. And you'll see our planning and preparation for a pandemic was something that we thought of long ago. And so we basically just switched gears from a hypothetical to something of, okay, now we need to act. And again, I really got to give kudos to our CEO of our firm, Juan Andrade, for taking the stewardship throughout this tenure of the pandemic and demonstrating to our clients, shareholders, et cetera, that we can prevail. So again, just wanted to give that backdrop. So with that, let's go to the first slide. Thank you, Rachel. So I think that for all of you, it sounds like most of you have risk management or experience in the industry. The most important thing I always say to people when I meet them for the first time in a risk assessment discussion is, do you have a business risk inventory? Do you have definitions of risk? And if you don't have that, to the starting point, the first thing you should do is make sure that, you're engaging with people and discussing risk with a common definitions for the various risk areas. So here what I've done, I've basically put together historically what I've used, financial risk. And when I think of financial risk, I'm thinking more along the lines of foreign exchange, interest rates, liquidity, and debt structure. Human capital is hiring, retention, succession planning, compensation and benefits. Operational is a large category, but think of change management. Think of business continuity management, M&A integration, and security. Legal compliance and regulatory, that's a whole host of items in there, but conflicts of interest, data privacy and security, litigation and reputational risk. Going back to my earlier comment about common language about market and credit risk, that's an example of their financial risk, but again, making sure you have a concise definition of what that means. The next thing I talk about is appetite and tolerance. As a risk manager, when you're the buyer for the firm of, I'll say, risk transfer products, it's important that you have engagement with the senior leadership team to understand what risks they want to retain, what risks they want to transfer, and what they're willing to trade for that risk. In many cases, you have a discussion about, is it earnings per share? Is it capital that you're looking to put at risk? But again, that conversation needs to happen before you put together a risk transfer strategy. And the earlier you get that conversation and know who the risk owners are and the people who make that decision, the easier it is for you as a risk professional to come up with solutions. And for all the people on the phone, whether you're going to be working for an insurance company, an insurance broker, or in the risk management field, this is something you're always going to have to keep in your back pocket. Understanding what that company's risk appetite is, what's their tolerance for risk, and how they are actually measuring that, right? Because again, it could be earnings per share, could be liquidity and cash flow, it could be capital. There's a whole host of metrics that can be used in that area. The next topic is governance and oversight. I mentioned before, as the chief risk officer for CBRE Group, and we had put together an enterprise risk management framework, and we also had an executive risk committee. And what I always like to say about governance and oversight of risk, everyone's a risk manager. You may have the title of the chief risk officer, but even in your personal and professional lives, if you see something, say something. Very important. That holds true throughout this profession. You really need to ask questions if you don't know the answer, and don't be afraid to ask questions you don't know the answer, and just tell people you'll get back to them if you don't know what that answer is in a timely fashion. Make it a sense of urgency. Policies and procedures are key. The important part there is once everything above has been taken care of, you're going to put those policies and procedures in place. It's going to govern things like what risk you accept, what risk you transfer, how do you transfer, how do you measure it? And then the last two items basically talk about technology tools. There are tools out there today that you can use to help you with your ERM program, or even just in general, your risk insurance programs. You want to be able to demonstrate they're creating value for your firm. Many times people think, okay, I'm buying insurance, the price goes up and down. That's not creating value, folks. You got to be able to talk the language of whoever you're reporting to, whether it be a general counsel or CFO, and make sure that you're creating value for the firm. Buying insurance is not creating value. It's actually destroying value, right? You're actually making a payment, and the idea is there'll be a claim at some point down the road. So a lot of times CFOs don't necessarily consider it value creation, right? So very important. Next page. So who are the risk owners, and who do you have to engage with? And this is, again, I just put a list of areas that's very important to get involved with. The first three, what I like to say, are the three-legged stool, right? For most companies, if you're dealing with the enterprise risk management framework, you're going to have the internal audit, the chief auditor, if you will. You have chief compliance officer, and then you have the CRO. Those three individuals must be connected at the hip. Internal audit talks more about controls. Compliance talks more about controls. I would say to you, and that's more of a COSO term that people use. But at the end of the day, it's the risk manager in many cases that needs to pull all this together, cobble it together in a way that can be communicated up to the C-suite in the organization. But again, risk management's everybody's job, starting from the CEO and the board all the way down to someone who may be in the mailroom. Shareholders. Very important that the shareholders have an understanding of the risk practices that you have in place. Whether that's given through the 10K annual, there's risk factors that are contained in that report, But again, you'll see any annual report for a publicly traded company, risks are identified throughout the report and risk treatments identified throughout the report as well. What are you doing about the risk? Investment decisions. What are you investing in? People, process, technology. Are you buying? Are you selling? Those are all important factors when it comes to risk management, and mergers and acquisitions are obviously a critical piece of that. Here's something that I would say to you that a lot of companies fail. They don't include strategy and plan, right? You need to engage with strategy and planning when you're in a risk management role, because the strategy and planning folks tend to have a lens that is going out further in time of what the future potentially looks like for the firm. And if you don't have, that's not integrated into your ERM or your risk management program, you're going to miss out on a lot of what I call emerging or risks that you need to start thinking about coming down the road at some point in the future. Now, I'm working for an insurance company, so clearly new product development pricing comes into place as far as risk owners and engagement. You know, what I will say about the insurance industry, I call it the 80-20 rule. 80% of the risks that are out there are uninsurable today because the industry is bound, for the right reasons, to use models to develop pricing in many cases. So that's, I think, we're at an inflection point in the insurance industry, and you see companies talking about it more and more, whether it's Aon or Marsh talking about how we have to be more relevant in our space. And in order to do that, we're going to have to develop new products, right? Those new products, some of the ways we've priced them in the past may not be the tools that we've used, namely historical loss data and information, may not be the tools that we'll have in business analytics to drive new product innovation going forward. Capital allocations. Once again, companies will allocate capital. I don't care what industry you're in. That's a decisions that made in the planning process. You know, it's a risk reward. Where do you put your capital? Where are you going to get the best return? Again, very important that you have engagement in this area. The budgeting process, planning, and the last one, performance evaluations. This is something I fought for throughout my career. What gets measured gets managed, right? And I think it's really important that, you know, I said before, everyone's a risk manager. No individual in the firm is not tied to risk management in some shape or form. So what I like to see is some type of performance metrics tied to risk management, where an individual, whether their job is, you know, could be they're an actuary, right? Well, what are they doing? Could be you're in a sales position. What are you doing to cross-sell and to manage the overall portfolio risk? Next page, please. I'll also stop for a second. Anybody have any questions, comments, criticisms? All right. The next item here is, you know, and this is the tenets of what we do as risk professionals. We identify, we assess, and we prioritize risks. Some people would call it the risk heat map. And, you know, very important in corporations that you have a risk heat map. It's a way for you to basically prioritize around where you're going to deploy your resources. So again, from that heat map, you would typically come down to what are your top risks. That number could be anywhere from 5 to 10 to 15 risks. You can't boil the ocean, so you're not going to look at all the risks that you've identified. But that's where the next item comes into place. You know, what's your time horizon? Is your time horizon that the impact is going to be in the next 12 to 18 months, or is it a 5-year time horizon? I like to think that when you're talking about risk beyond 12 to 18 months, that's more emerging risk, where you see that at the bottom bullet. Emerging risks are risks that you potentially, the impact is going to happen at some point in the future. And many times you've probably heard the people call it a black swan, right? Or a white rhino. These are the risks we're talking about. We're talking about those risks that you're not really sure of the impact. You're not really sure when it's going to hit. And in those particular type of risks, I always like to say, you really need to get out of your comfort zone and engage people who aren't in your organization, who are experts in their fields, who come from a different life experiences. Bring them into the discussion, because you know what you know. You don't know what you don't know. And it's really important when you bring in those different views on risk. In the past, prior life, you know, we'd bring in investment bankers. We would bring in people from the insurance companies. We would bring in subject matter experts on cyber, and we'd actually engage with them in dialogue about the emerging risks that they saw coming down the pike later. In fact, we'll talk about cyber a little further down the line. Again, you then put the risk treatment after you identify your risk, you identify your risk tolerant, you have inherent and residual risk. Think of the inherent risk as the raw risk. Think of the residual risk as after you apply treatment of the risk. It could be transferring the risk. It could be loss control. It could be many factors, but at the end of the day, that residual risk is what ultimately you need to report out on. And you need to measure that. You need to determine those risk treatments that you've put in place. Are they effective? Are they working the way that you hopefully designed them? And it's very important that you don't have a static risk management framework or program. It's always evolving. But again, in the normal tenets of risk management, avoid, retain, transfer. That's what we do. That's what we do in our industry. And it's very important to have a good understanding of what risks to avoid. Just steer clear. Don't take that risk at all. Don't be in that business. What risks we retain and what risks we transfer, right? So another idea here when I say retain could be tied to a captive. Many large organizations, corporations today take substantial risk. And in that case, you're basically an internal insurance company in many cases. Training, education, and awareness is a very big piece of what I call the risk management process. You're really not going to get, I'll call it the airtime and appreciation for all the things you do in risk management unless you're out there communicating and you're training people what's in the toolbox, what you have available to help them run their business. Because again, you're a cost center in many cases. So you have to make sure that people understand the things that you do help them achieve their goals. So one example I'm going to use is cyber. So probably about 10 plus years ago now, the firm I was most recent as the chief risk officer, we started thinking about cyber. And the first insurance policies came out, again, probably 10 plus years ago. And the first thing we thought about is this insurance policy covering the risks that we think are the ones we want to transfer versus the ones we want to retain? And what we found out after dissecting the insurance policy is many of the risks that we hoped would be transferred were not the risks that were. And so we were retaining some of those risks. So again, that makes you step back and say, okay, if I'm going to retain these risks, what are the strategies around reducing that risk to a level that you feel is comfortable within your risk appetite? Next page, please. So now let's get back to the topic at hand, which is real estate and hospitality. And what I always like to say here is occupancy, construction, and location. That's what it's all about in the real estate industry. So these are some of the asset classes that if you get involved in the real estate profession, residential, multifamily. And so when I talk about residential, I'm talking about both multifamily apartments. I'm also talking about single family homes. But there's a new asset class, and I say new in the last 10 plus years, called SFR, single family rental. This really was born out of the global financial crisis. And I'm going to talk about that later on in this discussion. But in 2008, we really had an inflection point in the industry. And I say the industry, really the world economy, and how risk was reviewed as the inflection point between capital markets, insurance industry, individuals, corporations, et cetera. So we'll dive into that a little deeper. Also on this slide, what I'd like to talk about is where have been the trends, winners and losers. So when I think about residential, multifamily, single family, that's on the plus side. That's actually an asset class that continues to have a lot of investment and capital flowing into it. Now, office, on the other hand, I'd say to you, not so much. And you probably all could guess, because many of you are not sitting in offices today. Corporations are having to deal with, many times their leases are 10, 15, 20 years. Well, COVID hit, and we all know we didn't go to the office for the most part, right? And even today, a lot of people are on some flex work schedule. So do you need all that office space? And so that's a big question that a lot of corporations are going to have to answer over the next few years. My own response to this is you basically have a double-edged sword. On one side, corporations had shifted to flexible workspace, common workspace, workbenches. And now you're going back to a work environment that people want more space, right? 6 feet apart, et cetera. So net, I do think that what's going to happen in the office space, is you're going to see more office space taken out of the big cities and more, what I'll say, in the suburbs. And the larger office space is going to have to redeploy some of that space over time. But again, I would say that's on the downside, office space. Same thing with retail. How many of you today go to stores to shop? Or what percentage of your time is spent shopping in a bricks and mortar store versus you're shopping online today? That phenomena will continue, right? And what I'd say there, that's another, for some of you who are in New York, all you got to do is walk down the street and see all the stores that have for lease signs on them when it comes to retail space. So I think you'll continue to see retooling of that space as well. Here's an area that has grown in leaps and bounds, which is industrial warehouse. Think of industrial warehouse as, things like Amazon, where tremendous growth when we were all home in our houses and during COVID, we were having boxes show up at the doorstep almost on a daily basis. Well, that's the industrial and warehouse space that we're talking about. And that continues to grow in leaps and bounds. The one thing I'd point out there from a risk perspective is that depending on, is there multiple tenants in that warehouse or is there one tenant like an Amazon? Big difference in risk profile. The next one is data centers. This is another one that has taken off leaps and bounds. As companies look to the cloud, as companies look to change how they're using data centers have become more and more prevalent, and the space required for data centers is on the rise. Medical office buildings and life sciences. I'm going to say we're always going to need these buildings and these type of locations. So that's on the plus side as well. Hospitality, hotels. That's an area where it really took a big hit early on in COVID, and now it's on its front foot, or at least coming back on its front foot. So that I use that for both, minus on the front end, but now plus, definitely an investment that's being made. So I want to go back to residential and talk specifically about wood frame. So when I think put my underwriter hat on now, as an organization, I'd say to you, we're really not interested in writing wood frame buildings, right? We're an organization when it comes to residential and wood frame, if it's part of a total portfolio that's made up of a lot of these asset classes, we'll consider it at some percentage. But if it's all residential and all, wood frame, many insurance companies are not interested in writing that business. So just be mindful that, what I said before, occupancy and construction location, it truly matters because all insurers are going to model these portfolios. Where is it in the country? Is it in a floodplain? Is it wind? Is it tier 1? Is it earthquake, wildfire? And convective storms, as you probably all know, that's the new risk that has impacted insurance companies extremely in the past, let's say, 5 to 10 years. And historically, while some modeled for it, it's becoming more and more prevalent that you must model for this risk because, again, that's where a lot of the big losses have come from over the last 5+ years. The other thing I'd say about hospitality, some of the risks to be mindful of, typically it's slip, trips, and falls, but human trafficking, sexual molestation. These are the type of risks that you think about. And during COVID, for hospitality, water damage claims and security, because people shuttered the hotels for periods of time. And now all of a sudden you don't have water running in these hotels. It's been shut off. You get mold issues. And so these are all types of risks that are to be considered during this, I'll say COVID, and now I won't say post-COVID, but living through COVID today. The other thing I'll share with you is technology from the standpoint of managing these different asset classes. More and more technologies coming out. Let's take water. If there's leaks, there's a way to have sensors today. And that's one way that insurers are starting to work with clients and actually, I'll say, share in that loss control, loss prevention, because the money that's paid to put these sensors in is actually a plus for the insurance company too, because the loss is going to be recognized beforehand. Also, security, just having security, whether it be CCTV or physical security, where people are walking the premises. And then there are also tools. We have one here at Everest called Zero, where see something, say something, whether it's a tablet or it's your iPhone, you can take a photo, share that with people, send it off. And in the single family rental space, that's been a game changer for that specific asset class, because in the past, you'd have to call someone, that person then have to call a vendor who's going to come out to the site. Today, it's all, for the most part, it's all done through apps that people would have on their phones, right? The last thing about COVID, the one thing I'll say about that is all these different asset classes have been impacted in a positive or negative way. And when we get to investing in real estate, you'll see just how some of these asset classes have done better than others, and why. Next page, please. So when you invest in real estate, it is truly a risk and reward. And what I mean by that is the more risk you're willing to take, potentially the greater the reward. So starting at what I call the most simplest way, or the most efficient way, is core and core plus, where you're basically dealing with assets that are, for the most part, fully leased up, have strong cash flows, and you're making an investment for the long term for that. It could be shorter, but usually you're looking at 5 to 10 year hold periods before someone would sell a core plus type of real estate. A value add, on the other hand, is something that it wasn't perhaps managed, it's undermanaged, maybe a way to describe that, but also, the property or the asset can be repositioned. And by reposition, what we're saying is we can go in, we can fix up that lobby, we can fix up the surrounding around the asset itself. We can restack and release up. And when we release up, because we've cleaned up the lobby, we've put more tenant type of friendly environment. So having a restaurant in there, having a dry cleaner, having maybe a grocery store, having something like that available. These are all things that would then correlate to people being able to charge higher rents. So that's the type of thing when we say value add. And then opportunistic is just, it's distressed asset, the cash flows don't work out, too much debt on the asset, someone else comes in, and again, risk reward. I'm going to get a bigger return, but it's also a bigger risk that this could fail, right, at the end of the day. And how do you invest? It could be debt, it could be equity, it could be through funds, commingled or private. REITs, for those of you who don't know, real estate investment trust is what that stands for. And they can be publicly traded or non-traded. And then the type of people that invest in real estate. You have banks, private equity, and then asset managers are the ones who work through these deals. But insurance companies are actually a big holder of real estate in their portfolios. Why? Because it actually is a nice match from a standpoint of asset and liabilities. Many of the liabilities that insurance companies, especially life insurers, hold are long-term liabilities. And so having real estate as part of the whole, I'll say, investment portfolio is one way to manage your overall liabilities to assets. Pension funds, and probably more so high net worth individuals. More and more you're starting to see even some of the big houses out there that are offering to high net worth individuals the ability, and think of your 401k. You're starting to even see in 401ks a real estate offering that comes through as well. The next thing I'm going to mention is, I say GFC, it stands for Global Financial Crisis in 2008. Not sure how many of you on the phone were in school at the time, but that was an inflection point in the industry, quite honestly. And I liken it to musical chairs, where what basically occurred, and we're going to go on to the next slide. What basically occurred, so if you could flip that for me, Rachel, is the GFC was a time where there was a lot of cheap money out there. You could borrow. You didn't have to put a lot down. And this went from individual people who were buying condos and homes. And, what I would say is very relaxed standards in underwriting from the banks. And there was this tool called CMBS, Collateralized Mortgage-Backed Securities. And suffice to say that there was a lot of a gaming of the system where ratings were involved. But at the end of the day, I talk about musical chairs. What ultimately happened is there was a call on the bank. Call on the bank meaning people were holding on to these loans, and now all of a sudden payments were due. And you might have heard AIG was involved with some Lehman Brothers, two of the big names that came out. And you might have also heard the term too big to fail. And basically that's what happened. At the end of the day, the financial markets would have collapsed if the government didn't step in. And the government stepped in and basically bailed out, AIG being one of the companies I'll reference, but it didn't bail out Lehman Brothers by way of example, right? So Lehman Brothers went bankrupt and it basically had to sell itself because at the end of the day, they didn't have, it was basically a race where they couldn't sell off the assets fast enough to cover the liabilities. If time was on their side, meaning they had 10 years, let's say, to sell off these assets, then probably they wouldn't have failed. But that was not the case. They had to move quickly and they had to settle their liabilities and they couldn't do it quick enough. So that's why they failed. On the flip side, AIG insured many of these transactions. And by doing so, they also got swept into it. The government did bail out AIG in this particular case. There's still arguments back and forth. AIG, to their credit, paid back their loan in advance of when it was due. So again, what I liken this to is poor underwriting. I liken it to cheap money. I liken it to not having good proper controls, not having an understanding of aggregation of risk, and not having an understanding of velocity, how quickly the risk could take place. But again, this really changed the landscape in the real estate world in particular. And I'll give you a book that if all of you are interested in reading more about this, it's called Other People's Money. It's a quick read. I'll tell you, I think I read it on a plane ride years ago when it came out. And again, in New York, there's an area called Stuyvesant Town, Peter Cooper Village. It was owned by MetLife. MetLife was able to sell it, and it was sold to Tishman Speyer and BlackRock. At the end of the day, MetLife walked away with a $3 billion profit. And I don't want to give away the story of the book, but all I can say is I highly recommend if you're interested in wanting to understand what happened during this period of time, pre-2008 in the real estate industry and the insurance industry, this is a really good read. And also a way to understand, how all these players kind of fit into all this and what broke down. But it goes back to what I said before, poor risk management. This was truly a break of risk management, greed, and at the end of the day, the government had to step in. And so today you might have heard about SIFI. SIFI is a way that the big banks and really financial institutions, they have to demonstrate on an annual basis to the federal government that they're actually able to withstand a shock if there was another run on the bank, if you will. All right. So anyway, I passed it on to you. I think that's a really good one to case study, if you will. In fact, I wouldn't be a bit surprised. In my years of going to grad school are over, but I wouldn't be a bit surprised if many of the B schools today are actually looking at the global financial crisis by case studies. Data centers. Any questions? First of all, I'm rambling away here, so any questions? I'll make sure I'm being responsive to folks. Cameron, you're on mute.
Can you hear me now?
Yeah, I can hear you. Sure.
All right, sounds good. I wanted to take it back to what you were talking about with the office space in the real estate industry. Do you think things like industrial warehouses and data centers can fully replace the demand for office spaces? Or do you think that there's still going to be some of this demand left over and that'll affect the real estate industry?
So are you saying basically redeploying offices to then be repurposed? Is that what you're asking? Kind
of. So if people aren't needing office spaces as much now, where's the demand for that going to go?
Yeah. So a couple of things. One is I use the word repurpose, right? So in New York, and I'll use New York City because I live in Connecticut, but my two sons live in the city, so I know how much rents are. So there's a strong demand for residential housing, right? People have been pushed out with the rental. So, you'll see some of these, if they can be converted, they'll be converted into residential, right? So that's one thing. Companies are looking at that. The other thing I'm going to say to you, and this is also our emerging risk, think about autonomous vehicles. Think about all the parking garages that are in New York City today. Think about, well, does that make sense to have all the charging stations in New York, or maybe somewhere in Jersey or Long Island or somewhere outside the New York City? So I see repositioning of assets is probably a way to say it, that will continue to evolve, right? But for now, to answer your question, take malls. I mean, there's a mall here in Stamford, Connecticut. It's probably 50% or more not occupied today. At one point, UConn University was thinking about taking it and converting it, whether it was for classrooms or housing, I'm not sure, but there was talk about that at one time. So again, you are seeing highest and best use. Remember before we talked about core plus, and we talked about different ways to invest in assets?
Mhm.
That's where companies will come in and they'll see it as an opportunity to repurpose an asset, right? And maybe convert that, that mall into something else, right? Maybe a data center, maybe it becomes a warehouse. And you are seeing that more and more. But again, probably go to your question, I think office, there's be a continued demand for office. Look, at the end of the day, I'll tell you, I'm old school, I'll say it that way, but I still think, folks, the way we learn, people learn is by doing and by being mentored. And I do believe, you're seeing it in Europe already, you've seen it in Asia, where people are coming back to the office. Again, I'm not advocating 5 days a week. I just think that the office space, you'll redesign it to meet the needs of how people want to work today. You'll definitely have maybe less in the big cities, but then corporations will also look to have offices in, let's say, suburban cities where they have a concentration of their people too. They don't want to lose talent. And that's another thing. There's a war on talent, folks. And so corporations are very aware that they can't call people back 5 days a week to work in an office. They'll lose some of their top, in my humble opinion, they'll lose some of their top talent or lose talent if that's the position they take. So again, going back to office, I think you'll see, yes, some offices will be turned into residential. Some offices will be just repurposed and, reconfigured for the way you all want to work, your generation. But at the end of the day, distribution and warehouses will continue to grow. Hospitality, I think, will continue to grow. And then the last one here is not so much, it's not an asset class as much as ESG, environmental, social, and governance. And let's put DEI, let's lump that in there too. That's extremely important to the real estate world today, right? Real estate today, if you don't have an officer, a DEI officer, you don't have someone that's responsible for ESG, you're missing a real upside opportunity, right? So, I pass that on to you all as well, because I do think that that's changed since I've gotten in the industry, right? It used to be like carbon footprint. People would talk about trading carbon to become carbon neutral. It was more lip service. Now you're seeing companies coming out with their annual reports, and they're actually demonstrating and showing what are they doing, what are they doing to stem global warming. Whether that be not building an office tower in a certain area where wildfires or catastrophes could occur. So again, companies are definitely, it's not lip service, it's more table stakes that companies must factor into when they're thinking about making investments in real estate. Also, talent, right? I can't tell you how many people I interviewed over the last 5 years that they asked the questions about ESG. What is the company's position on various topics that make up what I call ESG? So I hope I answered your question. So I didn't talk about hospitality in a big way, but I will say to you all, I'm sure we're all got pent up demand, right? We all want to get back to travel, but we're also talking about an economy that is slowing, right? So I do think that, large hotel chains and even smaller individuals, a lot of people don't realize the Marriotts of the world don't own all the hotels that have their name on them. They manage many of those hotels, but there are people who own those hotels behind that, right? Who actually own the debt. who actually manage that hotel. So I just passed that on to you because they're doing well. I mean, if you look at Marriott stock, if you look at the big hotel chains, they're doing well because, again, all of us want to get back out. I know I'm taking my vacation the last month of July, and I can't wait to get out of the four walls of my home with my family, right? And I think you're going to see more and more of a trend like that. So anything else? Anyone? Okay, I'm going to turn to the next slide then, and we're probably going to be a little early, but give you back some time in your calendars. So I mentioned this one last time, but I got a couple of things I want to share with everyone that I've picked over my career. I actually have a son who works for Chubb in the industry. And when he came to me, he was in school, you know, at the time he went to university, insurance wasn't on his radar. You know, he saw his dad had been in this business, and I'll tell you, I really enjoyed all the years I've been working in this industry. I've not been bored, right? And I'm going to tell you all that if you're bored in this industry, you don't have the right job. And there's nothing wrong with changing jobs, folks. Don't anybody box you in your career. There's so many things that you can do in this industry. But I share this with you because my son originally wasn't going to be in this business. And then he came to me and said, Dad, risk manager, broker, underwriter. I'm not going to, obviously I told you where he works, so you know he's in the underwriting field. But I tell you this because I shared with him what I think the critical skills are important for people to succeed. One is critical thinking. You have to be able to think. You have to be able to take data, information, et cetera, and just process that. And share your views and not be afraid to share your views. Not be afraid to ask questions. Not be afraid to take risk. The next thing that, you know, business analytics. You all hear about it. You all read about it. But I share with you, I've seen such a shift in the past 10 years in this industry. Look, relationships are always going to be critical to doing transactions in our industry, but the business analytics behind accepting a risk, trading a risk, pricing a risk, business analytics are 100% going to be driving that, right? And so that skill set is so important. And again, I share with you at Everest, it's a cornerstone of what we do and what we'll continue to do to differentiate ourselves. I would like to see insurance companies start to attack that 80% of the risks that are uninsurable. And I do think for things like IP, you know, they are starting to make reputational risks. They are starting to make inroads in that area as well. The last skill set is what I call emotional intelligence, right? Or IQ. You know, the one thing I'll share with you all when I think of my career is there have been times that I'm passionate about what I do. Well, that doesn't always resonate with people the way I come across, right? So just be aware of your own emotional IQ and understand that how you treat people, how you communicate, whether that be by phone, by email, by, well, snail mail. I beg to differ, probably not many people doing snail mail these days. But my point here is that it matters. It matters greatly to your success. And just take stock in it and just understand that the way you portray yourself, your brand is extremely important to your success as you go into your career. So with that, I want to thank you all for taking the time today, and I'm open to any questions anyone may have.
I can go and start off with a question. So this kind of has to do with real estate and kind of the market and everything. So obviously we're kind of going towards a recession and kind of in terms of the market, and we're not officially there yet, but it seems like that's kind of where it's going. How do you think this is going to affect the real estate market in the whole? And how do you see that kind of what direction the real estate market's kind of going in the next year or 6 months even?
So the technical definition is 3/4 declining GDP. So we're pretty close, but it's also sentiment, right? I mean, you also got to think about, you know, investor sentiment. So if you take the housing market, we talked about the different asset classes. Well, I don't know about where you all live, but I can tell you homes are being swept up still where I live. They come on the market pretty quickly. So supply demand is still in balance. I'll say it that way. I do believe, though, you're starting to see pullback on PE deals and investments in real estate. Because think about it. If you could have financed a deal at 3%, and now that same deal is going to cost you 6%, maybe that doesn't work for you, right? So I do think as we move towards whatever it is that we want to call it, a recession, right? I think that you're going to see real estate is a very cyclical industry. I used to say, some people would say 7-11, right? 7 to 10, 11 good years, and then you have a peak and trough in real estate. You go back in time, it's been that way forever. So we've had a run up. If you look at any of the stocks of any of the real estate firms, you've had a strong run up of the industry. So Andrew, I'd say to you that you're always going to need real estate. It's picking the right real estate at the right time that defines the winners and losers. I mentioned to you before some of what I think the winners will continue to be. I still think that those asset classes will outperform, but there are others like office, like retail, that I mean, I read a lot of, you can go online, Collier, CBRE, Jones Lang LaSalle, they all have economists and they put out reports. If you're interested in trying to get a deeper under the cover view, I suggest you take a look at their investor relations site, and they'll give you, I'll say the experts. I'm a neophyte compared to those people that make it their day-to-day job, right? But just my 2 cents, I think, again, we're in a cycle right now that's going into more pause for investors, but they're still investing money. There's still billions of dollars that's sitting on the sideline. And that's the other thing we didn't talk about. Asset managers of real estate, they typically have what they call, capital that's just on the sideline waiting to be deployed. And so another barometer is when that capital, the new capital coming in, starts to dry up. Dry powder, that's the word I was looking for, the phrase. So they have plenty of dry powder. The best investment managers, if depending on what they're investing in, obviously if they don't think they're going to get the return they're looking for, they start to pull back. And as an investor, if you're not deploying your capital, that you have, why you're going to invest it elsewhere is my point, right? So right now, there's still a lot of capital flow and money coming into the real estate sector. I just think that you're spot on in saying there's going to be winners and losers. And the industry is definitely, in that, if 2008 was low, 2009, think about it, you're over 10 years, 2010, you had a little pause, I'll say. But again, I just think that the tea leaves are there. Watch the signs and look at the asset classes. Where's capital flows coming in? Where's money coming out? And that's going to give you a good sense on where to make investments.
Thank you.
You're welcome, Andrew. Anyone else? Well, I wish all of you much success in your careers. And again, I leave you with that one comment I made earlier. This industry is a great industry, right? If you're doing something you don't like, try something else. You're young enough to do that, right? But also, don't be afraid to try something new. I mean, I can't tell you how many times as I became a chief risk officer, I took on responsibility that, quite honestly, I was not an expert. But I learned how to surround myself with people who are really good at what they did. And I learned how to make sure that if I didn't know the answer to the question, I got back to the person with a sense of urgency and got them the answer they needed. So thank you.
Thank you so much, Tim. We're so grateful on behalf of the entire foundation for you taking the time to share your expertise with us today. Again, this session has been recorded, so if you want to revisit any of the info that Tim has so expertly shared, it will be on our website after the fact. Will be posted probably by next week. I will share that as per one of Tim's latter points on emotional intelligence, EQ, and developing a personal brand, we have a session coming up next Thursday, same time, same place, with Mike Tiliakos, who is Assistant General Counsel of Argo Group, and we'll be talking about building interpersonal skills to strengthen professional relationships and exactly what Tim was talking about, how to build your personal brand as you go throughout your career. The session is titled Enhancing Your Professional Toolbox, so I hope you'll join us for that next week. Tim, thank you so much again, and everyone on the call, thanks for being here. Have a great rest of your day.
Be safe out there, everybody.
Thank you all.
Take care.
Thank you all.